As it's become common knowledge that mortgage interest rates are at the highs of this century, affordability and consumer appetite has really come into question. Funny thing is, we actually don't necessarily need rates to go down for those two things to tick up. We just need to manipulate/adjust the way mortgage rates and mortgage loans are amortized. Introducing the idea of a 60-year fixed rate mortgage. Welcome back to This Week in Mortgage, everyone. I'm Sam Battaglia at Mortgage Black in Beverly Hills. I hope you had a great week. All right, well, economics is a theory, and here is a interesting theory that I think I've come up with. The idea of 50 and 100-year treasury notes has been floated, I've heard a few times in the last 15 years. If this happened, we could actually pave the way for a 60-year fixed rate mortgage. Now, the bean counters and the actuaries won't necessarily agree with this, but they're not dealing in reality. They're dealing in idealized theories or theoretical idealizations, however you'd like to state it. But as we all know, that's not how the real world works. So let's say we did introduce a 60-year mortgage. Let's talk about the math behind this. Let's say you borrowed $1 million today at 7% on a 30-year fixed loan. That payment is $66.53 a month. Let's say you borrowed $1 million at 7% on a 60-year fixed loan. That payment is $5,923. It's about an 11% reduction in payment, which does actually help for two reasons. Number one, consumer cash flow, and number two, folks being able to actually qualify for a loan. The key to this is to keep the interest rate the same on a 60-year fixed as a 30-year fixed. And how you can facilitate this is not by changing the interest rate premium, but charge a little fee, 0.25% of a point up front to extend your amortization from 30 to anywhere to 60 years. A couple of reasons why this might actually work. The average mortgage is indeed held less than 10 years. Now, these stats are not going to be able to take into account what's happened in the last few years, so I'd say that number is actually probably going to go up slightly higher than 10 years, maybe a 13 or 14-year lifespan, given how about 80% of all mortgages out there, I believe, are under 5%, and we are well above that now, so those will be held for a while, but they will eventually be paid off. Now, that said, if you've ever wondered why your mortgage person always talks about the 10-year treasury, that's why. There is a 30-year treasury, which you would think a mortgage that's amortized for 30 years would follow. It actually follows closer to the 10-year because most mortgages have a life of less than 10 years. This would be initiated by FHFA, the conservators of Fannie Mae, Freddie Mac, the Treasury, the Federal Reserve, the government, whoever had to get involved to initiate these bond sales to investors. And I'm guessing that there wouldn't be a lack of demand from foreign countries to buy U.S. treasuries that were long dated and U.S. mortgage-backed securities that were long dated 50 or even 100 years. We'll see if that could shake out. Who will be upset by this? I think the banks and some mortgage servicers might be a little bit upset because they're going to have to give up some cash flow, which is basically the principal you're putting into your house. But I think at this point, from what we've seen over the last 2 decades, banks and mortgage servicers have been helped out enough by the U.S. consumer that it's time for them to give a little bit of it back in terms of less cash flow. But that said, they will make the same amount of interest for a longer time, so they will end up winning in theory. Now, in this day and age of the consumer being squeezed every which way, every little bit helps. And I know it's only about an 11% reduction in payment, but that 11% can help households pay a car payment or two or a lot of their utilities, and really nobody getting hurt, and introducing a new and exciting treasury note and mortgage-backed security for everybody to sell. This will also help get rid of some of the payment inflation that the Federal Reserve has caused to the U.S. consumer and to the world for that matter over the last year and a half. And here's the other deal. If you don't want to pay your mortgage in 60 years, just like today, you can self-amortize. So you can get a 60-year mortgage and pay it off in 10, 20, 30, 40, or 50 years if you don't want to pay the interest over that time. So you can self-amortize, but it is nice to have options. And as we all know, Economics is not a perfect science. It is the theory of economics, and here's a theory I wanted to float by you today. Okay, everybody, that is my show for this week. I hope you enjoyed it. As always, please take care of each other, be a good neighbor, do unto others, and have a safe weekend. Thank you so much for your time.